Well, hello and good evening, ladies and gentlemen. Welcome to tonight's webinar. So this evening, we have the privilege of having Ong Xun Xiang from Lion Global Investors, who's here to tell us about this new ETF that Lion Global Investors is launching. Okay, it is called the Lion-OCBC Securities APAC Financials Dividend Plus ETF. And as I understand, it is the world's first APAC Financials ETF. All right. At this juncture, I'd like to also share with you the fact that this ETF is now open for subscription during its IOP period. So we have an article on FSMOne.com where all the instructions as well as more information about the ETF is contained. So I'm actually going to put the link in the chat section for you right now. You can click on that link to go get the instructions to subscribe. But in the meantime, also do give your attention to Xun Xiang. He'll be sharing more about the investment case for this ETF. So over to you, Xun Xiang.
Yep. Thank you, Jonathan. Okay, let me share screen. Good evening, everyone. Thank you for joining Jonathan and I during your Wednesday evening. I'm Xun Xiang from Lion Global Investors, and you can call me LGI's ETF guy. So today I'm here to share with all of you about our new ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. So this is an ETF that will help you achieve two benefits: earn stable dividends and also at the same time invest in APAC's financial strengths. So if there's anything I want all of you to take away today, it'll be actually two key points. So I can say them upfront right now. The first would be about 5%, minimum 5% per annum quarterly distribution. And the second would be that this ETF is the world's first APAC Financials ETF. And before I talk specifically and dive deep into this ETF, maybe let me first introduce LGI to all of you in case some of you are not so familiar yet with us. So LGI, we are part of OCBC Group, and we are one of Southeast Asia's leading asset managers. Today, we manage up to 71 billion Sing dollars of assets for our clients. And we started our ETF journey more than 6 years ago, where we listed our first ETF, which was the S-REIT ETF, back in October 2017. And since then, between 2020 to 2022, within 18 months, we listed 3 ETFs. And they are namely the Hang Seng Tech ETF, China Leaders ETF, and our Singapore Low Carbon ETF. So 3 ETFs within 18 months back then. And after that, earlier this year, we also listed Singapore's first active ETF, and that is our Lion Nomura Japan Active ETF, powered by AI. So if we apply the cutoff as of the end of 2023 here, 3 of our 4 ETFs actually achieved top returns in their respective segments among the SGX-listed ETFs in Singapore in 2023. So one of them, for example, our S-REIT ETF achieved top returns among the SGX-listed REIT ETFs in 2023. Among China equities ETFs listed on SGX, Hang Seng Tech ETF also achieved top returns. And if we compare for Singapore Low Carbon ETF, it was also the top returning ETF among Singapore-listed Singapore equities ETFs. And all these have helped propel us forward from 0 AUM in 2017 when we first started to around 860 million of AUM today, and propelled us even further into becoming one of SGX's top 5 ETF issuers. And based on SGX data, our ETFs are also among the top 10 ETFs held by retail investors like yourself and also me included. And if we zoom into the segment of SRS investors, our ETFs are also within the top 10 held by SRS investors. And zooming further into trading turnover and volume, our ETFs are also within the top 10 traded ETFs. And specific mention for our Hang Seng Tech ETF, it was the top traded ETF in 2022 and 2023, basically 2 consecutive years. So all these have prompted us to build and also create quality ETF products for the Singapore investors and the Singapore ecosystem. And some of you might ask also, why the financial sector? Why having a financial sector ETF right now? So there are some key reasons. So the financial sector, to define it, includes companies that provide services and products that focus on the growth, storage, and transaction of money and assets. So it is a traditional and also old sector that started when we had barter trade in terms of our seashell monies, which then evolved into gold, and then paper currencies like what we use now in Sing dollars, US dollars, and also credit cards where we are able to transact using credits. And after that, it further developed into allowing mobile payment through QR codes. And now on the frontier side, it is also allowing central bank-backed digital currencies. So with all these said, what I want to say is that the financial sector, although it is a traditional and old sector, it has prospered throughout the centuries because of one thing. It is an essential capital provider for companies and for economies worldwide. And when we talk about the financial sector, it is not just about banks, but also about an entire ecosystem. So for example, if you look at investment management, like LGI, there's also insurance, and also brokerages, for example, like iFAST, which we have here, and also exchanges, where we are listing this ETF on the SGX. So having this ecosystem is important because it ensures diversification across different businesses that have different interest rate sensitivities, different reactions to macro events, and also helps to smoothen the flow of capital and investments, enabling economies to trade globally. So right now I've covered why financials. The next thing would be why APAC Financials. So in terms of the financial industry, it is actually one of the world's most profitable sectors. It generated more than 12 trillion US dollars in terms of revenue in 2022. And within this region, we sit in Asia Pacific. More than half of Asia Pacific's adults are actually underbanked. And this represents the largest opportunity sets across different regions. If we even look at Middle East or Africa or even Europe, APAC has the greatest underbanked segment within the region. And all these also means that APAC banks can grow even further by serving the underbanked within the developing Asian markets. So this one key thing. APAC banks can grow further by serving the underbanked. And next would be about the high savings rates within APAC, which is much higher than world's average savings rate of 24.7%. And within APAC, ASEAN and Singapore are in fact the key drivers behind the high savings rates of APAC. So to put into perspective, out of the world's top 30 banks by market cap, 13 banks come from APAC. So all these are important because when there's high savings rates, deposits is deeper. And where there's more deposits, there's actually more capital to be able to help funnel and fuel the economy and improve economic resilience for the region. So APAC's high savings rates is important in improving economic resilience. And when we talk about APAC banks, a lot of us actually think about developed markets, for example, like Australia, Japan, or Singapore. But it also includes developing markets, for example, like Indonesia, which is fast growing, Malaysia, and also Thailand. And since the past few years, and in fact throughout history, in terms of the past few decades, we have also observed APAC banks, for example, like our three local banks, usually pay consistently high dividends. And all these help to lay the foundation for stable dividend income. So if we, based on what we have observed, they have paid like 50 to 60% of distributable income and reinvest then the remaining 40 to 50% for growth. So APAC banks have generated this kind of dividend payout history. And with this, we can conclude that APAC banks provide quality income. And this lays the foundation for stable dividend income within this ETF. And that's why we are able to pay minimum 5% per annum for quarterly distribution. And in terms of the financial sector, remember I mentioned earlier that it is an ecosystem. It doesn't consist of just banks, and also consists of insurance, investment services, and also brokerages and exchanges. And when we zoom into the segment of insurance, APAC's life insurance industry was actually the world's largest. with 5 Asian countries featuring among the top 10 global markets by return premiums. Specifically, until 2026, APAC's emerging markets like Thailand, Indonesia, and Malaysia are expected to grow at an annual growth rate of around 20%. So all these present insurance as another high growth segment within the APAC financial sector that we shouldn't ignore. And remember this ETF also, in terms of the name, Lion-OCBC Securities, APAC Financials Dividend Plus ETF. So some of you might be wondering, what is in the plus? There are 3 key catalysts within the plus. The first is about cushion profitability. So in terms of profitability, we have already seen in the past 2 years, global banks already posting decade high profits and also return on equity. And all these have been attributed to the US Federal Reserve higher interest rates that have helped to power the improvement in terms of net interest margins. And this has helped boost the sector's profits. And in 2023, the sector ROE is in fact expected to reach 13%. So this is around 50% higher than the 9% average ROE for the past 14 years. And in this kind of scenario that is about to be, because we are right now already expecting some US rate cuts, US Federal Reserve rate cuts happening. In this kind of scenario happening, it is important to invest more in the well-capitalized banks because they are more likely to maintain profitability. So I'll repeat and reinforce this again. Well-capitalized banks are more likely to maintain profitability. And this is also what the ETF will invest in, because we are investing in the top 30 largest and most tradable APAC financials institutions. And most of these tend to be well capitalized, and they are more likely to maintain profitability. So this covers the first catalyst about profitability. The second catalyst I would like to cover would be about the tilt towards Asia, which is causing the rise in APAC wealth. So to put into context and perspective, banks grouped along the Indian Ocean are already home to half of the world's best performing banks. And in the next 10 years, more APAC banks are actually expected to join the world's global top 100 banks. And global wealth is already expected to exceed more than 500 trillion US dollars this year. So this is nearly 5 times of global GDP. And the biggest wealth source will come from APAC, translating to roughly 200 trillion in this year. So this rise in APAC wealth is important because it's expected to catalyze the growth of APAC financials, because there will be technically more assets to be able to pledge as deposits, so they are able to lend out more. And also at the same time, for the investment services side, they are able to potentially manage more assets and generate more fee revenue. So second point, rising APAC wealth is expected to catalyze the growth of APAC financials. And this is why the tilt towards Asia is a potential catalyst that will propel this APAC financial sector even forward. The third catalyst would be the APAC financials pivot towards capital light and digital models. And based on the McKinsey study, capital light models tend to use much less in terms of balance sheet, but actually bring higher return on equity and net income. So in the past 6 years, what this study analyzed is that transaction activity actually used only 16% of capital or balance sheet, but brought in 33% of profits for the financial institutions. So 16% to 33% is roughly like a 2 times multiplier. And because of this benefit, a lot of financial institutions see, they are embracing digital transformation, such as incorporating AI, big data, to go capital light and also go digital. Specifically in its annual report, DBS mentioned that digital customers are consistently more valuable, with an increasing share of income, sustained higher income per customer, better efficiency, and also higher returns. So all these prove the case that being capital light and going digital can help to improve profitability. And those banks or financial institutions that can afford to go capital light and go digital are usually those that are already well capitalized. So they are able to spend more to be able to go through this transformation and pivoting. So all these help to prove the case and also justify the case that the pivot towards capital light models is a growth catalyst. And as we speak now, APAC Financials are actually still at an attractive entry point right now. So if you look at the price to earnings ratio, if we compare to the STI, the STI currently has around 50% banks. So these 50% actually come from the 3 local banks. The STI currently trades at around a 16 PE ratio, which is actually significantly higher than the PE ratio of the index we see here. And if we compare to the IHS REIT Leaders Index, it's currently trading at a 23 PE ratio. So our index is actually trading at more than half lower than the S-REIT Leaders Index. If we compare in terms of the price to book ratio, it's comparable to the S-REIT Leaders Index, despite it having been hit and punished by the high interest rates. But if we compare to the STI, what you notice is that it's actually much favorably lower. Our index also has the 3 local banks inside as the top 3 constituents. For the STI, they are also among the top few constituents, but you will notice that the price to book ratio is actually significantly lower, 0.4 times lower. So actually, all these present it as at an attractive valuation point right now. And next, if we compare in terms of the net dividend yield, same thing is at 5.9% now. So we are able to actually meet the 5% target payout easily because we are already at 5.9% in terms of net dividend yield. But if you look at the STI, it's at 5.1%, despite already being 50%, consisting of 50% banks. So I think it's clearer to see that actually having an APAC Financials index and ETF actually helps to boost the net dividend yield. But if we compare then to the S-REIT Leaders Index, it's actually quite comparable. There's only like a 0.3% in terms of difference. And remember that APAC Financials tend to pay out roughly 50 to 60% of the distributable income. But for Singapore REITs, due to the tax transparency treatment, they pay out around 90% of their distributable income as dividends. So because of that, there's still the growth element in APAC Financials because once they pay out the 50 or 60% of distributable income, there's still the 40 to 50% to reinvest for growth. But for S-REITs, mainly it's more of a pure income play. But for APAC Financials, what you see is actually a play not just on income, 5%, but also at the same time, there's potential growth to capture in terms of capital appreciation in the sector. And as we speak, the growth catalysts are long-term and take time to be priced in. And some of you might also ask, okay, we might be expecting US rate cuts in the second half of the year. How could this impact APAC Financials? So remember I mentioned earlier in the earlier part of the presentation when introducing the financial sector, I shared that the financial sector is an ecosystem consisting of businesses with different interest rate sensitivities. And right now, as we speak, because it is part of the entire ETF consists of roughly 6 to 8 countries in terms of the different constituents. So there's actually geographical diversification because each of the countries are at different points in terms of their respective interest rate cycles. And furthermore, in terms of the expectations of US rate cuts, these actually already prompted reductions in terms of savings accounts interest rates. So when, for example, as in, if it's just me, when savings accounts interest rates actually fall, it means your deposits and your savings will not earn that much interest anymore. So you might need to invest to take risks, to invest, to be able to gain a higher return. So all these actually could drive more investment activity within APAC, redirecting capital from the banking side towards wealth management and towards insurance businesses. So this is one use case we see that even though there's a reduction in terms of interest rates, is mainly more on redirection of capital and reallocation of capital towards equities or towards wealth management and insurance products. And on the banking side, the banks, because they are financially sophisticated, they are still able to protect their net interest margins by increasing positions into longer term fixed rate assets. For example, like buying longer term bonds or giving out more longer term loans. One example would be DBS, which already made a specific and conscious decision to put 30 billion Sing dollars of their fixed rate assets in Q3 and Q4 to protect against lower interest rates. So with all these said, the financial sector is an ecosystem that is diversified across businesses. And because of this specific fact that it is diversified across businesses, it has prospered throughout the centuries, despite being an old and traditional sector. So with this, that's why we launched the Lion-OCBC Securities APAC Financials Dividend Plus ETF. And it is the world's first APAC Financials ETF. So this ETF tracks the IH APAC Financials Dividend Plus Index, which tracks the 30 largest and most tradable APAC financial institutions that's listed in APAC. So it is designed to provide access to stable dividends, but also at the same time, growth within the financial sector. So you will see countries, for example, included like Australia, Hong Kong, Japan, Singapore, Korea, Indonesia, Malaysia, and also Thailand. And it follows a 3-step in terms of the index and portfolio construction process. So first step is about index criteria. You will see that includes sectors like banking, insurance, investment services. And the last one would be about specialty finance and services. So this is a specific but interesting subsector because it means it actually includes the digital banks, for example, like C and Grab inside the specialty finance and services. So it means that if the banks, digital banks, they grow big enough, for example, more than USD 1 billion in terms of market cap, or they start to pay high dividends in the future, they might get included into the index. And this is what makes the index future-proof, to be able to include eligible and quality constituents, which at the same time still gives quality income, but at the same time give the potential growth in the financial sector appreciation. And the next criteria, which I would say is important, is also giving a 2-year average dividend yield. So instead of 1 year, because sometimes financial institutions may just have a very good year, they just pay very high dividends within one of the years. And in the next year, they don't pay so much in terms of dividends. So that's why we used a 2-year average dividend yield to be able to ensure consistency of high dividends and to meet the 5% target dividend yield. The next step will be about index selection and weighting. So in terms of the market cap threshold is simple, USD 1 billion. And there are also 3 in terms of weightage caps involved. There's the 7% single stock weightage cap. So no stock can be above 7% when it's done during the semi-annual balance. And there's also a 20% country weightage cap. So this country weightage cap is important, which I will discuss even further later. So it ensures that not each of the country, they will not exceed 20% within the entire index. So this actually limits country risk and exposure for markets, for example, like Korea, sometimes Japan also, or even Hong Kong, because the Hong Kong listed Chinese banks are included in the index. So this actually limits the exposure, but at the same time allows you to benefit from high dividend yields from these constituents. And there's also a 5% cap specifically for Indonesia. So what you end up in the end will be a portfolio of 30 APAC Financials constituents weighted based on free float market cap. And this index is rebalanced every March and September. So it means every 6 months. So the next semi-annual balance that will happen will be in September. And there are 3 key features for this ETF. I've made it simple and easy to understand. FIG, which stands for Focus on Income and Growth. So I hope you remember, focus on income and growth. So in terms of focus, it focuses on the top 30 largest and most tradable APAC financial institutions. In terms of income, easy to remember, 5% per annum quarterly distribution. And the third will be about growth, potential capital appreciation in the APAC financial sector. And the index, since its launch on the 2nd of February 2024. So all these, what you see are live index data. It's not backtested data, because although we backtested more than 10 years ago to more than, I think, 2012, but we are only showing live index performance. So based on live index performance in the past 2 months, the index actually achieved an 8% return in 2024 year to date. But if we compare to the STI, we actually perform more than 6% better than the STI during this same period, and also more than 11% better than the IHS Leaders Index. So it's significant, right? In terms of the outperformance, you outperform STI by 6% during this period, and outperform IHS Leaders Index by 11% since inception on the 2nd of February. And here are some of the index characteristics. What you see is a colorful mix of different countries bundled together. So you see Japan exposure is roughly 21%, Australia 20%, Singapore, which is made up of the 3 local banks, at around 20%, Hong Kong at around 19%. So this, when I talk about Hong Kong, it actually includes some of the Hong Kong listed Chinese banks, but the exposure is quite limited. But at the same time, you still gain exposure and also access to the high dividend yields paid by Chinese banks, which are at around 8 to 9%. There's also South Korea at around 16%, that's spread out over 3 or 4 constituents, and also 1 Malaysia constituent, which is Public Bank Berhad. So what you get in the end is a financial sector portfolio that is diversified across APAC. And here are the index constituents. So what you see is a different mix of constituents. So in the top 3, you see the 3 local banks, DBS, OCBC, and UOB. And among the top 10, you will see more Korean financials like KB Financial, Shinhan, Hana inside. So these are the 3 Korean financial conglomerates that are among the largest within the Korean market. And also you see Japanese banks or financials, for example, like Sumitomo, Mizuho inside. And let's not forget also about Australia, which is part of the Asia Pacific region, where the big 4 banks are inside, like CBA, NAB, Westpac, and also ANZ. So all these are important because it provides a geographical diversification across different countries within the region. And if you see that ICBC is actually the world's largest bank, but it's actually weighted at only 3.5%. And this is where the magic of the country weightage cap comes in, because the country weightage cap is 20%. And most of the Chinese banks are actually among the world's largest banks. But the ability, so that's why we are able to, because of this country weightage cap, able to cap the country exposure to China, but also at the same time help the ETF be able to assess the 8 to 9% dividend yield from these Chinese banks. So for example, you see the Chinese banks actually are of relatively smaller weightage like ICBC, ABC, BOC, and also another BOC constituent, and also China Merchants Bank, which is among the 6 largest banks within China. So they are of high dividend yield, but of low weightage. So because of this, the country exposure is capped. But at the same time, you still gain access to these high and stable dividend yields, because a lot of these are state-owned banks. They are usually more protected by the government. But although they are risky, through an ETF, you gain geographical diversification. It's diversified across the stocks and also different sectors. And just nice, you have the number 30, where they spread across 30 different constituents to ensure a proper risk management for your portfolio. So right now, I will in fact cover about 2 key constituents within the index. One of it is National Australia Bank, which is an Australian bank. There's a case study example of about digitalization. Another bank would be about KB Financial. And it's an interesting constituent because Korea has all along been an underinvested market. But precisely because it's underinvested, a lot of investors don't really understand. And through an ETF, what you get is immediately Korea financial exposure. which is more managed, more weighted, but also at the same time, you gain access to the potential growth within the Korea market. So I'll talk about the first constituent. This will be National Australia Bank. It's Australia's top business lender. It has a 22% market share as of 2023 and has delivered a strong performance. Cash earnings up around 9%, profit up around 16%. And key thing is that for its core business and private banking unit that focuses specifically on SME customers, the profits actually grew around 22%. And this was attributed due to digitalization of its account opening. They actually contributed to 50% in terms of growth in new account openings since 2020. So this is a case study example about digitalization and how the pivot towards capital-light models and digital models help to catalyze growth of a financial institution. So since then, in 2023, in January, until March 2024, you will see that share price actually grew by 25% during this period. So this is National Australia Bank. It's in the mature market, one of the big four markets, big four banks within the Australia market, and Australia's top business lender. The next constituent I will talk about would be KB Financial. It's also among Korea's biggest banks and achieved record high gross operating profit in 2023, which was up around 18% year on year. So it's an interesting constituent because it actually has two insurance arms. It has its own KB Life Insurance and also another insurance arm where it acquired Prudential's South Korean insurance arm for around $2 billion. And the merger was actually effective in January 2023. So since then, if you compare between January 2023 until March 2024, the share price actually increased by 50%. So a lot of us actually don't really understand the Korean market. And because of this, we underinvest in the Korean market. And so this was actually a hidden gem. It increased by 50%. And there's actually still upside potential identified based on the average analyst target prices that have been set. There's still 15% in terms of upside potential. And because if you do not read financials in Korean or you don't know much Korean, you wouldn't really invest in a market like Korea because the language barrier is really high. But because of this, you missed out on some investment opportunities. But through an ETF, you actually still gain geographical diversification and access to actually these kind of hidden gems. And KB Financial Group has been an interesting company. It actually also grew net profit by around 8% year on year annually in the last 4 years and still remain well capitalized. And remember, I mentioned about the first catalyst that well capitalized banks are more likely to maintain profitability. So this is one of the case study examples of two of the catalysts where it's more likely to maintain profitability and also at the same time grow even further. So to conclude, the Lion-OCBC Securities APAC Financials Dividend Plus ETF has 3 key features that helps investors focus on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution. And also potential growth within the APAC financial sector. So the target payout is 5% per annum, minimum quarterly distribution for the first 2 years, as you see here. And the SGX stickers are easy to remember. YLD, you can think of the word yield to make it easy to recall and remember. And also YLU. So we hope you remember 5% per annum for quarterly distribution. Remember that it is a good sustainable yield, and we hope you continue to earn stable dividends and invest in APAC's financials today. So I'll now pass the time back to Jonathan, who will cover more about ETF or even matters specific to FSM.